Hello and welcome. You're watching Commodity Champions and I'm Manisha Gupta. Gold prices hit yet another record highs this week as soft US labor data buoyed expectations of a rate cut by the US Federal Reserve. The yellow metal has gained nearly 40% so far in this year. The strong central bank accumulation and heightened global uncertainty are also supporting prices. As per official data, China's central bank extended its gold buying streak to a 10th straight month in the month of August. Other precious metals, including silver and platinum, have also gained around 43% and 55% respectively so far this year. Well, to discuss the outlook for gold, we have now with us Philip Newman. He is Managing Director, Metal Focus. Philip, hi, thank you so much for joining us here. First of all, your sense on the gold prices, because this rally seems unstoppable. What is your sense on where we could see in sense of prices?
Well, you're right. And first of all, good afternoon. You're right, it does seem unstoppable. It is quite incredible. I mean, when we broke through 3,500 for the second time, we thought we would see a period of consolidation. That hasn't happened. And again, at 3,600, we thought exactly the same. And here we are today. It's interesting that you mentioned about the Fed potentially cutting rates next week. But that's interesting because that seems nailed on for some time now. Yet here we are with gold hitting new highs. So we do feel like the rest of the market that the Fed will reduce rates next week by 25 basis points. I think what's really important, though, is the language around that announcement. And I think the market is watching that very closely about how many more rate cuts are likely this year. I would say to you, though, we do feel that prices will still, I think, consolidate around these levels, even though as a research house, we are still bullish for gold for this year and also into next year as well.
Philip, would you say that 25 basis point of a rate cut is now baked in, factored into the prices?
Absolutely. But again, we've been saying that for a little while now. And yet with the new economic data, it seems to find, new impetus. And so, as you know, we have new inflation data coming out this week for the US. And of course, markets were watching that very closely. But I think, as I said, 25 basis point, I think it'd be quite a surprise. Does the Fed not reduce rates? I think that'd be really quite a shock. And I think something quite dramatic has to happen for that to come to fruition. And I think the other side of that, the chances of a 50-point cut also, I think, seem quite unlikely.
Oh, yes. So while you are bullish on the prices, Philip, and we have had reports suggesting that the prices can go to 3,750, 3,850, 3,800, 4,000, perhaps 5,000, 6,000 in the next 2 to 3 years. I mean, there are all kinds of reports out there. What is the best case scenario that you see for the gold prices, let's say in the next 6 to 12 months?
Yes, you're right. We do see some quite aggressive forecasts coming out now. And I think it would be unlikely that you would find anyone that would be bearish on the price. So I think in terms of the prices, I think we would call that perhaps by the end of this year, I think 3,800 is quite possible. It's not just about the Fed, of course, in terms of its rate cycle. I think it's everything else that you've been discussing for some time now. Fed independence has gone front and center, debt levels in the US, and of course, the weaponization, the uncertainty created by tariffs as well. But I think 3,800 seems not likely, but it's quite possible given the speed that we're seeing. And we could see further strength into 2026 as well. I think what I would caution, though, because so much is investment driven by institutional investors, that adds, I think, a degree of volatility into the price. And so, for example, a period of consolidation is almost quite healthy if we're thinking about the prospects for the price, rather than sort of a straight line rise up.
Philip, a lot of people feel that they have missed this buzz the way that we have seen gold prices run up. So would you say every correction perhaps would be bought into?
Absolutely. I think there's plenty of money on the sidelines. There are plenty of investors that didn't see this coming, and frankly, Metals Focus didn't see this coming. I'll hold my hands up to that. So I think there's quite a lot on the sidelines. And of course, prices that were quite recently thought of as resistance points are now support points. So I think, yes, there's quite a lot of money on the sidelines that would come in and, again, support the price, whether it was a low of 3,400 or 33. I think these levels would be very well bought into.
All right. Philip, talk to us about the physical demand as well, because that is something that really seems to be picking up. It's not about speculative money. It's not about just paper money or even ETFs, by the way, which all seem to be doing quite well. But would you say it is the physical buying in case of gold, holding of gold, that really seems to be catching up now?
Well, if we're including central banks in that, I know in your introduction you touched on China. So we still see, I think, relatively strong buying there in sort of absolute terms. I mean, our figures for the first half of this year, they were down on the same period last year, but that was either, I think, a record high or close to record high. So in absolute terms, central banks are still very present on sort of the physical side of the market from a demand standpoint. And even if they may well potentially be backing off at these prices, I think if we take a step back, then I think they are aggressive on the demand side. And I think our current forecast for this year is about 900 tonnes for calendar 2025. So from that point of view, yes. I think from a retail standpoint, it's much more mixed. The US, for example, which is quite an important coin and bar market, there are some heavy liquidations there. So that market is very weak. In Europe, which is really led by Germany, we're seeing a bit of an improvement so far this year. And in India, again, I think quite a mixed picture. But I think the market I think there are quite bullish price expectations, and I think that is fueling some relatively decent levels of bar demand there as well, or here, I should say.
Yeah, Philip, you are in India. You're in Mumbai right now. Thank you so much for coming to the studios, by the way. And you have been meeting people, talking to them as well. What is it that you're picking up their reaction to these gold prices? Well,
I think it's quite difficult to separate the gold price, because a lot of people we're seeing are manufacturers or wholesalers with sort of export business as well. So trying to separate the price from the tariff or the potential tariff is quite difficult, and the uncertainty that's bringing. For example, if they're shipping into Western markets, this, like India, is an exceptionally important period of time, or coming up to that, when the trade should be really restocking. And there's a lot of headwind there, and how they're trying to deal with that. And thinking about the local market from a jewellery standpoint, you're getting moves to lighter products. All that's been going on for some time now, and also the potential, perhaps on the margin, but the potential for lower carats as well.
The exchange market also seems to be quite strong, by the way, with old jewellery being bought for new jewellery there. Either way. How are you looking at demand from here on, with where the gold prices are trading right now? I remember last September 2024, gold was trading at 2650. It's trading at 3650 right now. Is it becoming a very niche market as we move ahead from here? Because at these current levels and the kind of forecasts that the markets are throwing at, is it going to become difficult to buy?
I think, again, from a retail standpoint, I touched on jewellery, so they're moving to sort of lighter weight or lower carats. I think in the retail investment space, there are opportunities to produce, smaller weight products. So I think that helps to keep the retail space broader. But you're right in terms of that risk that it does become more of a high net worth institutional play. But other markets are, I think, are also quite active. But that's always a risk at these prices, until, say, consumers can perhaps start to adjust to some of these levels.
The tariff impact is something that we already have seen in sense of positive for gold going forward. This whole play of central bank buying, with the de-dollarization play coming in, with the markets believing that the US dollar index will decline from here, and September is just the beginning. We will see much more interest rate cuts coming in from US. How are you playing all of that in gold?
You're right, there's quite a lot there. I mean, as I said, I think from a de-dollarization standpoint, we think that will continue. Of course, for some central banks, simply because of how the gold price is behaving, by definition, it's now in a higher share of their reserves than they were perhaps expecting it would be. So we'll have to see how some of those play out. Do they adjust that higher? Do they pause? We still feel that, as I said, because of our forecast for the year, you may well have other countries coming into the market. Now, we don't have any, I think, special information that would suggest who they may be. But I still feel there's perhaps more activity we could see coming in from that part of the market, and therefore that should help to support prices going forward.
Philip, just one more point about Indian markets there. Do you see demand getting impacted? I mean, you've said 900 tons is what we could see in sense of imports. You've also talked about on how Indians have been buying gold for thousands of years, one of the top buying countries when it comes to retail here. Are we looking at a dent going forward, really? Or do you think it's just that the market will change from retail perhaps to institution?
Well, I mean, again, I guess it depends how you look at it. I think on the investment side, I think the ETFs, there's a little bit of growth there. We've seen some modest growth from a gold standpoint. Silver has been much more exciting. But on the gold standpoint, a little bit of movement. As I mentioned, I think the physical investment is reasonable. And again, from a jewellery standpoint, we'll have to see. As you know, the 22 carat price just has gone through 100,000 rupees per 10 grams. So I think it's too soon to see how the market will react. I think as it stands, you know, from a festive demand point of view, that is down year on year. But what I would also say to you, it's not down aggressively. Okay. And I think that is quite encouraging.
All right, so there are some positives coming in for gold as well. But Philip talked about silver, and that's exactly what we will be talking about after this very short break. And joining us for this discussion would also be Michael Durenzio from the Silver Institute from the US in a short break.